What's up, y'all? Welcome back to my advanced fundamental analysis series. This is actually part two, where I'm going to cover a couple of liquidity ratios and liquidity, just in terms of how how available is certain funds to cover short-term obligations. So, generally speaking, in the corporate world, short-term debt or short-term obligations is usually debt that is owed within a year or less, generally speaking. So the two ratios that I want to talk about that allow you to evaluate the liquidity of a company, well, not only the liquidity and give you an idea of solvency, short-term solvency, is called the current ratio. And I'll go over the other ratio in just a second. But the current ratio is basically a ratio that quantifies a company's ability to pay short-term debts. So, uh, how do you calculate the current ratio? So, the current ratio, if you go to the balance sheet on your company, you want to divide current assets by current liabilities. So, this means this means that you won't be evaluating things like fixed assets and stuff like that, not total assets. You just want the current assets, so your short-term stuff and your current liabilities. So when you divide those numbers, it'll give you a number. Sometimes that number will be a small number, sometimes that number will be a big number, depending on the company. So we're going to look at a couple of different examples, and so that I can spell it out a little bit more for you. So let's start with Ford. This website, macrotrends.net, is what I'm using. I find myself liking this website. I'm new to it. I kind of stumbled across it some weeks ago, and I find it very useful. So anyway, Ford Motor Company. So I wanted to choose something that has I wanted to choose something that has uh, quite a bit of inventory on a regular basis, and that's the car industry, of course. And just so we can double check that, let's see what that inventory is looking like. So inventory is in the, is this billions? Yeah, looks like it. So yeah. So that's 10 billion in inventory, right? So that's why I chose this one as an example. So let's go back to other ratios. Current ratio. So as per this website, it says that the current ratio for Ford for 3 months ending was 1.34, June 30th, 2020. So this means that Ford's, for that 3 month period, Ford's current assets were 1.34 times its current liabilities. So this tells you, as an investor, that Ford does have the current assets on hand to cover all of its short-term obligations. So that's a great thing, right? You want to see that for companies, especially if it's going to be a long-term investment. Um, I'm trying to see if I can find the year, but whatever. So let's just use that as an example. So 1.34. All right, everything's great, or is it? So one thing that people don't realize is that the current ratio also includes inventory. Excuse me. And so it assumes that the company would be able to liquidate all of its inventory if those short-term liabilities became due. Company would be able to liquidate all of its inventory and use all of its current assets to uh, cover that short-term debt. And so we all know that's not the case. Inventory takes time to get rid of. It takes time, it takes effort, it takes money. It's a lot that goes into churning through that inventory. So a better ratio that digs a little deeper into that I believe gives you better insight into that short term liquidity and solvency is called the quick ratio. So the quick ratio, the only difference with the quick ratio is that it does not account for inventory. So it's current assets minus inventory divided by current liabilities, and then that'll give you a number. Most of the time, that number for the quick ratio is going to be lower than the current ratio. Uh, Sometimes it'll be a big discrepancy between the two numbers, and then sometimes it won't. So let's see. So current ratio for Ford for June 30th, 2020 was 1.34. Let's see what the quick ratio was or is for that same amount of time. 1.23. So like I said, a little bit lower, not a huge discrepancy between the numbers, but this number still tells you that Ford has the current assets on hand to cover its short-term or current liabilities. So great. That's the type of things that you want to see as an investor when you're evaluating your company. So just digging a little bit deeper into solvency and management and things of that nature. So let's look at another example on Tesla, since it's they sell cars and stuff. Not only sell cars, but they manufacture and sell cars. So for the same period of time, Tesla's current ratio is 1.25. So for 3 months ending June 30, 2020, 1.25. Here we go. Remember that the quick ratio takes inventory out of the equation. So, some companies they try to beef up that current asset column with those inventories, but remember, inventory is sitting. It's sitting. So the quick ratio for Tesla for that same period of time is 0.92. So this tells you that without that inventory, Tesla does not have enough current assets on hand to cover its short-term obligations, its current liabilities. So, and as you can see, quick assets 11.32 billion, and then quick liabilities or current liabilities 12.27 billion. So you can already see that difference there. So 0.92 uh, is the quick ratio. So not significantly lower, really, in the grand scheme of things. But whenever I see, uh, whenever I see this sort of quote unquote discrepancy, um, this tells me to go investigate inventory. Let me see what's going on with the company's inventory. Are they churning through that inventory on a regular basis, or is inventory just kind of sitting? So there are ways to evaluate that mathematically, but I'm not going to get into that now in the interest of keeping this short and simple. So join me for the next series of video uh, of the Advanced Fundamental Analysis series, where I will discuss some ratios and continue this conversation where we'll investigate why or how we can determine what's going on with that discrepancy between the current ratio and the quick ratio. Hopefully, I'll be able to find an example of, just kind of some significant differences in the two. I wasn't able to tonight, but I'll keep searching, and hopefully, I'll be able to before the next video, so that we can do some real deal investigating in this between these two ratios and how you can kind of determine further, what may or may not be happening. So thanks for watching. If you have any questions, feel free to hit me up. Thanks. I already said thanks for watching, but hope to see you in the next video.